All right. Hello and welcome, everybody. Thanks for joining us on today's live webinar. Right now, two of Australia's biggest property engines are telling a very interesting story. Brisbane is running hot, fueled by strong migration, tight listings, and major infrastructure investment. And at the same time, Melbourne, after a period of correction and negative sentiment, is stepping out of the shadows and building momentum month on month. Today, we're going to unpack what's really happening on the ground and what the data is telling us, and how these two markets may once again be moving in sync. I'm Tim Graham from Hotspotting, and joining me today is someone who knows these two markets inside and out. He's got over a decade of experience working directly with developers, builders, and thousands of buyers across Brisbane, Melbourne, and beyond. And that, of course, is Daniel Petersen of iBuyNew. Dan, how are you, mate?
Yeah, really good, Tim. Thanks
That's
for
all
having
right.
me.
Anytime. Looks like we've got a fantastic attendance. You might have been a genius in pushing this back a week for being unwell, because we've gained a couple of extra hundred followers, which is pretty impressive.
Yeah, well, I'm certainly a lot better form than I was about a week ago with a bit of influenza, but yeah, apologies for those that might have been a bit of an inconvenience for, but I'm back on my feet now.
That's it. All right, mate. Well, let's get into it. While you're getting ready there, I'll just give everybody a little bit of housekeeping. We're planning to have a chat for about 45 to 50 minutes today. We will try to leave about 10 to 15 minutes at the back end for any of your questions. You're welcome to ask questions throughout. I'll keep an eye on the Q&A panel. If there is anything that you ask that is integral to what we're talking about at that time, I might jump to it. Otherwise, by all means, keep loading up the Q&A, and we'll try to get to as many questions at the end of the presentation as possible. Over to you, Dan.
Yeah, great. All right, Tim. Well, I think I'm going to maybe just kick off and just literally in a minute just explain a bit about iBuyNew for those that have joined that may be not familiar with our business. We're ultimately a property investment advisory firm, and we specialise in new and off-the-plan property. We've got a very deep belief that if you're investing in residential property, there's some really distinct advantages of investing in something that's new and off the plan. And most people that have been investing for a while will appreciate and understand that. But really, our business is about identifying really high performing residential off the plan investment properties. And that's what we've been doing for about 15 years now. So, in a nutshell, we help first time investors. We help people that are very experienced investors find out worse. We also help a lot of clients that have got super setting up self-managed super funds and getting some of that super working for them in property. So we help a whole range of different property investors. Our approach is what we call it the four E's. We start with evaluation. We really evaluate someone's goals and objectives, their financial position. We help empower them to try and make good investment decisions by providing recommendations supported by all of our research and modelling. We help them execute on that, including the leasing property management of the property. And then we have what we call enhance, which is actually a relatively new part of our service. As part of an annual review, we have a dedicated role. A guy who's a former financial planner, but Brett basically does an annual review of your portfolio and normally comes up with a series of recommendations to help optimize that portfolio for you. Our approach is really to study all the developments, whether it's house and land, apartments, new townhouse developments, villas, all sorts of residential property that's being constructed and developed, brought to market. And we have what we call our property evaluation selection framework. We look really closely at the location, the underlying development, and the developer and their team. And that helps us identify at any point in time a relatively small number of recommendations that we have. Normally we have somewhere between 15, maybe up to 30 recommendations. That ebbs and flows over time. But normally around the country, we'll have different property types, different settlement dates, different price points that by and large, most investors, we will have a recommendation or multiple recommendations that we can put forward to them. So yeah, that's how we operate, Tim.
Yep, very good.
So I think we're going to kick off and start with Brisbane and just talk a little bit about the Brisbane market.
Mm-hmm.
Do you want to?
Yeah, I'll sort of set the scene for that to begin with. And this is a trend that we've been noticing for probably a couple of years now. But if we sort of think back, for a long time, the dominant narrative in real estate was pretty simple. If you wanted to get capital growth, you bought a house, and preferably on a big parcel of land. And that was the real way that you got capital growth. And, for a long time, we weren't seeing that in the unit market. But that story is certainly starting to change. Across the country, more buyers are now choosing units not only, not as a compromise, but more as a strategic choice. They want location, they want lifestyle, they want safety, and most of all, they want affordability. And for many well-positioned units, they tick all those boxes. But now we're also seeing capital growth in the unit market as well. We're seeing all sorts of cohorts of people choosing to live this way too. So you've got the downsizer market, first home buyer market, the lifestyle seekers, and new migrants, all driving competition in the unit market. And in many suburbs, unit prices are now actually rising faster than houses. And it's not just a shift in preference that we're seeing. It's this whole thing is reshaping the real estate landscape right in front of our eyes. If you go to the next slide, Dan, we'll talk about where we're really seeing this the most. So, in terms of the cities that we're actually seeing the biggest impacts in, Sydney and Melbourne, buyers are trading space for location. It's driving a really strong demand for middle ring and well-connected units. In Perth, unit demand is rising the fastest of any city, and we've seen a real drive in that inner city market and also coastal areas. House prices have just pushed up so far that there's such a differential that, buyers are leaning more towards those more affordable alternatives. And in Brisbane, units are now outperforming houses on price growth more than anywhere else in the country. And that's fueled by interstate migration, tight supply, affordability pressures, but most of all, a massive undersupply of units. And I'm sure you'll talk to that when we do get into the Brisbane slide, Stan.
Yeah.
In Brisbane,
Yeah.
they just simply can't, build enough stock, to keep up with the demand they've got there.
Yeah, I mean, it's one of the sort of you say, Tim, that in this commonly held view that houses will outperform apartments and apartments don't appreciate.
Hmm.
It's just not correct. It's factually incorrect, and
Mm.
it's very normally what we see. It's very area driven. It's very area based, and in some parts, like you just touched on Brisbane, there's some inner parts of Brisbane where the pace of growth on apartments has outperformed houses by a
Yeah, that's right.
significant margin, and that's really for all the reasons you touched on.
Mm. Yeah, and look, it's across the board. If you've got really well-connected, well-located units, they're no longer the poor cousin. They're becoming the smarter investment for both home buyers and investors. Um, Okay, so moving on, and today's market affordability is obviously the driving force behind a lot of buyer decisions, and that's where units are really having their moment. In October, unit prices outpaced houses across most capital cities, and buyers are really, particularly first home buyers, sought that lower priced alternative. We saw the strongest monthly gains in Perth, Adelaide, and Melbourne, each rising around 1.5 to 1.6%. Brisbane and then those other major lifestyle markets of southeast Queensland, like the Gold Coast and Sunshine Coast, they weren't far behind. Even in Sydney and Canberra, where we'd already seen a wave of growth, prices still held firm there on units. And what we're seeing now is a clear trend that, as affordability tightens, more buyers are turning to units. They're becoming the go-to entry point for people trying to enter the market. And as I say, this isn't something that's, just in the last couple of months. It's been happening for a number of years now.
Yeah.
Okay, and then when it comes to unit rents as well, it's not just on the capital growth that we're seeing really strong demand, but we've also seen rental growth is far better, but also yields are far better in units as well. So, in the past we often saw that houses dominated growth and yield, and now that gap's really closed. And in many cases, it's basically flipped completely. So across Australia, unit rents are rising almost twice as fast as houses. In the combined capitals, unit rents are up over 4%, while houses are sitting closer to 2%. And it's the same story in the regions: stronger rental growth, better yields, and in many cases, lower vacancy rates there too. So that's a bit of a myth as well. A lot of people thinking that you must buy in a capital city in order to achieve growth. The regional markets have been performing very well for some time now.
Mm.
But one of the key points I want people to take away from this conversation today, Dan, is that it's really important to understand that Australia isn't one market. You've got 15,000 suburbs, maybe 30,000 markets when you take into account you've got house and unit market. And they're all moving in different ways at different times. There's different dynamics, and all of them are at different stages of cycle. And over the past 14 years, I've been lucky enough to work across global real estate markets. And the one thing that I've really learnt from that, or the key thing that I've seen with smart investors, is they're not only, data driven, but they're cycle smart. They know when to enter, when to leave. They don't chase trends, they anticipate them. And the next couple of slides I'm going to show people is just here in Australia, how much every capital city can move in different ways at different times. So if you could move on to that next slide, hopefully that video will start for us on its own. Yep, that's moving along now. So essentially what this graph is showing is the last 30 years of median dwelling values by capital city. And what you'll notice is that they all move out of cycle. Very rarely are the two cities moving at the same rate at the same time. And this is why it's important to understand market cycles. As you'll see here, like it's the number one leader isn't always been Sydney. It's moving all the time. And what you're going to see on the next slide is how quickly it can change, even going to 2024. So I think might be a little bit of a lag on what I'm seeing on screen now. We reached 2025 at your end or 2024 at your end.
Yeah, it had for me, Tim, and it's just actually just sort of gone back to the start.
Okay, let's move on to the next one. So this next slide shows the 12-month capital growth up until December of 2024, and obviously we've seen Perth as the market leader there with 15% growth. What I want to highlight here is a couple of markets. The first one being Darwin at 0%. The next one being Melbourne -3%. So what we've got here in the 12-month period, you've got a market like Perth, which has absolutely boomed, and a market like Darwin or Perth, Darwin or Melbourne, which are -3 or 0%. So you've basically got an 18% spread from top to bottom. And it's worth noting, no matter where you were in the country last year, you had the same interest rate. You had the same economic turmoil happening overseas. You had the same Donald Trump tweets. You had the same Prime Minister. But there's an 18% difference from top to bottom. And that's why it's important to understand these cycles. If we go to the next slide for me, what you'll see now is where we sit at the end of October. And you'll notice some big changes. If you drop to the bottom there, Darwin, 11.4%, now the national leader, coming off the back of 0%. The other notable one here is, and we'll touch on Perth quickly. We sort of mentioned that we thought the Perth market may have hit a peak probably 9 months ago now. It's probably getting closer to 12 months ago now. Now, we never said that we expected prices to drop, but we knew that rate of growth couldn't continue. And sure enough, month by month, that 15% has dropped back. And Perth is a very different market to what it was 10 or 15 years ago. It's not that it's not a market that is so reliant on the resources and the iron ore and things. We've got a much more diverse city there now, so we don't expect prices to fall. And in fact, we've got such a lack of listings over there that they really can't. But the real highlight here is to say, well, -3% in Melbourne, we're now in the positives of 4%. And that there is a telling story. It's actually 3.4% here because it's the end of September, that data. At the end of October, it's now 4.4%. So that slides a month out. But that is showing that the Melbourne revival is well and truly on its way, Dan.
Yeah, very much so. And I think I'll talk to that, sort of what some of the drivers behind that are in a minute.
Yep. And then, if we wanted to also touch on rentals quickly, vacancy rates have fallen again from 1.4% at the end of 2024 to just 1.2% nationally today. And remember, obviously, a balanced market would be about 3%. So at these levels, Australia's rental market is severely undersupplied. You look at Perth, Hobart, and Darwin, they're all sitting below 1%. Adelaide and Brisbane aren't too far behind. And that means that tenants have basically got no options in those areas. And obviously that pressure is what keeps pushing rents higher month after month. Even Melbourne and Sydney, which typically would have more stock on market, they're still sitting well below what we consider healthy. So when people wonder why rents continue to rise, this is exactly why. And there simply isn't enough homes to meet that demand. Now, Dan, did you want to take us through some of this Brisbane data now?
Yeah, sure. Yeah. So I'll probably start with Brisbane, and then we might sort of turn our attention to Melbourne. And the reason we want to talk a bit about Brisbane and Melbourne in parallel is that they're two, they're two very big markets, and historically they actually have tracked each other quite tightly, actually, up until about 10 years ago, or a little bit more than that now, 10 to 12 years ago. This chart, what this shows is the black line is the median property price of Brisbane versus the median property price of Melbourne, being that lighter blue line.
Yeah.
And really what you see is the two markets have very much tracked each other, but there starts to be this disconnect from about 10 years ago. And Brisbane really went into a period of actually very flat growth, very, very flat to modest growth. Whereas Melbourne had some pretty good growth from about 2014, all the way through to about 2020, 2021 even. And then you've had this, so Melbourne sort of started to trade at about a 20% premium to Brisbane. And that way for actually some time, for around about 10 years. And then you've seen this period of very rapid growth in Brisbane, as you touched on before, Tim. Like probably the last 3 years in a row, we've talked double-digit growth,
Yeah.
and we've seen over a 4-year period almost 60% growth in Brisbane. Whereas Melbourne, over that same time period, has been flat. In fact, the last 3 years, had some negative figures running up until the last 8 months, where we've seen this turnaround, and we've seen 8, 9 months now of positive price growth.
Mm.
But what has emerged over that relatively short period of sort of 4 years is now that 20% premium that Melbourne was trading at is now a 20% discount.
Yeah,
In
that's right.
fact, in some parts of Melbourne, if you look at some parts of Melbourne versus some parts of Brisbane, that spread is as much as 40%. And I'm not talking about some of the greenfield areas of those two cities. I'm talking more about the inner suburbs, some
Mm.
of the blue chip suburbs that are actually relatively comparable in terms of proximity to CBDs. You're talking a 30 to 40% spread in median
Mm.
prices. So it's an amazing shift, that we've seen in the market, and it does create quite a significant opportunity.
Yeah,
But
absolutely.
the one thing about Brisbane, we have a lot of clients asking us at the moment, what's our view around Brisbane? Do we think it's peaked?
Mm.
And our response to that at the moment is no.
Mm.
We actually don't think it's peaked. We actually think out of if you compare Brisbane and Perth and Adelaide to a slightly lesser extent, they've had quite a similar growth profile over the last 3 or 4 years. The one thing that we believe, or there's a couple of things we believe that Brisbane has going for it, which amounts ultimately to just far more momentum than what a Perth or Adelaide market's got.
Mm.
There's a couple of stats here on the screen that it's got very strong population growth at almost 3%. The vacancy rate is super tight. Anything less than 3% is below equilibrium, but at 1% or less, it's an
Yeah.
incredibly tight market. You've got rents growing really steadily, and you've got capital values growing strongly, still in double-digit territory. So
Mm.
that's just sort of top level. But what's really driving this momentum that I'm talking about? There's ultimately four things. There's the population growth. So Brisbane's population growth, and I probably should expand that to talk about Southeast Queensland. Southeast Queensland's population growth, if you look at the last 3 or 4 years compared to the 10 years, the average of the 10 years prior, we're talking double the population growth.
Yeah.
It's a big jump. And alongside that, the housing industry, the new construction industry for residential, it is at absolute capacity. It has
Yeah.
been. It's not like it's idle or it's constrained. It is getting diverted. Some of that capacity is being diverted onto state and federal government infrastructure
Major
projects,
projects. Yeah.
but a lot of it is steady, and they just cannot keep pace with demand. So the housing supply market is incredibly tight. I'll bring up a little bit of data on that in a minute. The other thing is the infrastructure spend at around 200 billion is the combined, just for the Queensland state government and the federal government funding that's going into some of it.
Hmm.
We're talking a $200 billion program. It's actually pretty similar to what is very similar to what we see in Victoria or Melbourne. But that program is now at its absolute peak. I mean,
Mm.
the state government has never spent that level of investment on infrastructure,
Mm.
public infrastructure, and we know that ultimately leads to generally improvement in services, in infrastructure, and ultimately capital values.
Yeah. And
The
Daniel,
other
I know we talked about this on our ticker episode, but you were saying that, one thing that's worth highlighting about the Olympics, and I know they call it the Brisbane Olympics when it's really the Southeast Queensland Olympics, because there's a lot of other, offshoots like regional markets that'll do well out of it as well. But the interesting thing is that if you go back and look historically at all of these previous Olympics that have run before it, they're always in capital cities. I think you mentioned, Brisbane is a pimple on the side of the earth compared to a lot of these other major cities that have hosted the Olympic Games. So this is transformational for a city like Brisbane.
Yeah, no, absolutely. And the Olympic opportunity is big. Like, yes, I think with the Olympics being announced, actually, incredibly early
Mm.
relative to when normal host cities get announced. Not They're normally announced around 7 or 8 years prior. It was announced 11 years prior because of what went on with COVID and the deferral
Yeah.
of the Tokyo Games from 20 to 21. But being announced 11 years early over the last 3 or 4 years, yes, we have probably seen some of that momentum coming off the back of this, the announcement about Brisbane or Southeast Queensland being the host for the 32 Olympics.
Mhm.
But a lot of it is still to come, and I'll just come back to that in a minute. In terms of just to show you some of this is the quarter by quarter population growth of Victoria versus New South Wales, and Queensland. And you see that, yes, the Victorians' population growth is stronger. I mean, it's basically the strongest in the country,
Mhm.
apart from this period where we had lockdowns. And Melbourne went into, well, the most lockdown city in the world outside of Buenos Aires. Had a period where we had actually quite a lot of outbound interstate migration. You had quite a bit of outbound international migration, and you had an absolute seizing of all inbound international
Students
migration.
and yeah.
So it goes negative for a period and then it normalizes and you have this spike through 22, 23 as a lot of that gets brought forward.
Mm.
But the population growth, and it's probably not ideal seeing it on this chart, but the last 3 or 4 years, if you look at that orange line, it has come off slightly over the last couple of quarters. Unfortunately, the ABS data, when you talk about population growth, there's a lag of around 4 or 5 months. It's
Yeah.
hopeless, but it is running now at circa 110,000 a year into Brisbane, and only a few years earlier it was really ticking at about 80,000. So you're talking about a 30,000 40,000 per annum increase in population growth from what it's typically been used to seeing. So that's very significant when it comes to the housing market. On the supply front, this chart here, this is just apartment supply in inner Brisbane. Sorry, it's inner Brisbane and the middle and outer parts of Brisbane. The bulk of it, of course, is sort of the inner and city fringe of Brisbane. And really, what you see here is when the industry was sort of delivering quite decent numbers to market, you're up around 10 to 14,000 a year of new apartments coming to the Brisbane market. It's been incredibly tight. It's been diminishing now for a number of years. A whole lot of reasons behind that, which we probably won't have time to go into right now. But you're now running at sort of around 1,500 a year of new apartments coming to the Brisbane market. We haven't got the outlook here, but I can tell you, for those that are interested, we're happy to share this. But when you look at the next 3 or 4 years of known projects, the number gets up to about 2,500 a year. It's gonna be tracking at about 25% of where it needs to just to meet demand, just to meet the demand that's coming from population growth. We've got an incredibly tight market in Brisbane, and on top of that, you've then got the Olympic Games coming in 32, and as we touched on, Tim, some of that momentum. A lot of it is related to the infrastructure, and on the chart here, there's a few of the key things called out that the Queen's Wharf development, the Brisbane Metro, Brisbane Live, which is going to be a phenomenal new stadium, entertainment complex in the eastern part of Brisbane, the Brisbane Waterfront, the Vic Park, which will be the host of the main stadium for the Olympic Games, the Cross River Rail, just to name a few.
Mm.
Then you've got all the very specific infrastructure upgrades, some of the new stadiums like the Vic Park that we just spoke about, the Queensland Tennis Centre, the Athletes Village. There's a lot of things that are on this chart here and this one here, which is not just centred in Brisbane. Some of it actually is on the Gold Coast, the Sunny Coast, and a little bit more regional. But look, the bulk of it happens to be in and around Brisbane, and quite a bit of it's in the inner part of Brisbane. So there's an enormous amount of infrastructure. There's around $11 billion being spent specifically on Olympic infrastructure. Now, the bigger play here at play here in terms of infrastructure is all the other infrastructure that's being delivered on top of that, which is mainly road and rail. But there's hospitals, there's a lot of other transport that's being on top of what we just touched on, being built and constructed over the next 7 or 8 years. So come 2032, Brisbane is a fundamentally different city. It has evolved enormously the last 10 years into truly what is now a world-class city. But I think if we look back, we get to 2032 and we look back at what that city has become, my view is it will probably become the best city, or at least in line with Melbourne and Sydney. It's going to be no longer the sort of small, sleepy country,
Yeah,
large
absolutely.
city. It's going to be a world class, truly world class city,
Yeah.
and it will get put on the international stage. So if you think about people that are potentially migrating to Australia, or they're thinking about doing it over the next 3 or 4 years, they first and foremost think about Melbourne and
Hmm.
Sydney.
Yeah.
Come 32, and there's been 4 weeks of global television and Southeast Queensland shown in all its glory.
Mm.
I think a lot of people will start to think about Brisbane first. So,
Mm.
so we do expect a real population surge between 2032 and 2035. It's already running at record levels, but we think it has got the potential to even pop higher. So
Mm.
all of those things are fundamental to really good capital value growth and momentum continuing in Brisbane. We talk here just about, Tim, we've done this joint study on what's happened to all the host cities around the world. If you look back over the last 25 years, and you kind of roll through, you start from Sydney and move forward through Athens and London, Paris, Tokyo, etc. Um, there's some really key themes that come out of that. The first is this population growth you normally see around 2 or 3 years post the games. So there is always a spike in population growth. The infrastructure that happens in all these host cities are normally between about $5 and $10 billion. Brisbane happens to be a bit more than that, but they, they are big investments.
Mm.
When you take on being the host city of an Olympic Games, it's a big investment. It's a big commitment. It does lead to job growth, and normally sustainable job growth. So in each of those host cities is somewhere between 100 and 200,000 new jobs being created. And that leads ultimately, all those things have led to the host city seeing over a 10-year period, the 8 years prior to the games and the 2 years after, when you study each of those host cities, they see population growth. And Sydney was a classic example of this, was very much at the top end of this range, between 100 and 150 percent price growth over, on a median basis over that 10-year block. It also happens to be double the price growth of the rest of the country. So if you take Sydney as one example, Sydney saw about 145% price growth over that 10-year period that straddled the 2000 Olympics. The rest of Australia saw about 60, 65% price growth.
Yeah. Wow.
So it's still good growth, but nothing like that host city. And the same applies to when you go through places like Athens, Tokyo, etc. So there's some of the common trends. And if you just try and compare that to, okay, how does Brisbane compare to some of those previous host cities over the last 25 years? Well, firstly, the infrastructure plan going into Brisbane is higher. It's
Yeah.
more. It's a bigger plan. And if you try, and that's comparing it on, Australian dollar terms, it's actually got a rising population. And we've seen that over recent years, and we expect that to continue for Brisbane. But when you compare it to some of the other host cities like Paris, London, Tokyo, they've got very minor population growth. Somewhere like Tokyo has actually got declining population. Despite that, those host cities saw good population growth. So with Brisbane having very strong population growth and price growth, we expect to kind of outperform probably some of those other host cities.
Mm.
As I touched on before, or you sort of referenced this pimple on the back of the earth is quite often what people in offshore, so foreigners that are living in Northern Asia or North America or parts of Europe, and many of them never even heard of Brisbane.
Mm.
They know Sydney and Melbourne, they might know Canberra even, but they very rarely even know what Brisbane is. Well, that's all going to change.
Oh, yeah.
Talking about it being a sleeping giant, I think it does truly have that potential as it gets put up in lights, for that 2 to 4 week period.
Mm.
The other thing about Brisbane is it is a hugely undersupplied housing market, as supported by some of that data we spoke about before. And that was not necessarily the case in some of those other host cities. They're actually quite well supplied. And then lastly, it's actually quite affordable still. It has grown, there's no question. Brisbane prices have appreciated by circa 60% over a period of 4 or 5 years. But relative to Sydney, it is still affordable. And
Yeah.
there's still a sort of 30, 40% price gap between Sydney and Brisbane. So there's still plenty of headroom there, we think, in the Brisbane market for future growth.
Yeah, I agree.
So, Tim, if we maybe just turn to Melbourne, and we've probably spoken now a fair bit about Brisbane, but
Mhm.
as you touched on a little bit before, we see exactly the same thing, and I think the market is starting to pick up on this, but maybe not understanding some of the background to it. And I'm keen to perhaps just unpick that a little bit for the audience.
Yeah.
So I'll just go back there. Firstly, just top level, you do see that the population growth of the Melbourne market's running at about 2.7%, and the forecast is to be very similar numbers to that. I'll bring that up in a minute. The current vacancy rate has been in decline now for the last 2 or 3 years. It's sitting below 2%, averaging 1.8. There's pockets of Melbourne that are below 1%. And certainly a few of the recommendations we've got at the moment, the vacancy rates are as low as about 0.8%, so very, very tight markets. And they're seeing, as a result, really good, strong growth in median rents. Depending on where, they're as high as about 5 or 6%, the median growth rate. And that's been pretty consistent now for 2 or 3 years. Because the capital values in Melbourne over the last 3 or 4 years have been pretty flat, but you've seen this median rental values growing at, in some cases, as high as 10% per annum in some areas. The yield has got really strong in Melbourne.
Yeah.
So our clients that have persisted with Melbourne, that have held on to Melbourne, they may not have enjoyed much capital growth, but they are seeing really, really good rental yield, and they've got good positive cash flow coming out of those investments.
Mm.
But Melbourne has definitely turned, and there's 3.4%. If you bring that forward another month, it's now 4%.
Mhm.
That's very much on track to get back to sort of average growth levels of around 7% over a full 12-month period, and we've seen 8 or 9 months now of positive price growth in Melbourne. But I just want to go back and just explain to the audience a little bit why was Melbourne stagnating for 3 or 4 years, and there's not one reason behind that. There's a few, but the three biggest reasons is, firstly, and I'll start with land tax. I think most
I
people.
was going to say, it might not be one particular reason. It might be one particular person who kicked it off, though, Dan.
Yeah, I don't want to go back to those days. So let's
No,
let's move
no.
forward. Let's look forward, because we're not going to talk politics on this webinar. But yeah, I know what you're referring to. And look, the state government, the way they had handled COVID, the way they handled the lockdowns, it led to an enormous amount of handouts going to the private and to business. And they, in response to that, the state government did a number of things. It wasn't just property taxes, but property taxes were one that started to ramp up. Now, I just referenced land tax here. It probably should be property taxes because it's slightly broader than land tax. But we saw stamp duties increase. We saw foreign buyer stamp duty surcharges increase. We saw vacancy
Right.
taxes for
Yeah, vacant
introduced.
housing.
Yeah, we saw a whole lot of new taxes. We saw land tax rates increase and thresholds get pulled back a little bit. Now, that if you were an existing property owner, your land tax it might have gone up, 50 or 60% as a result of that. But people lost a fair bit of perspective in our view. Some of these land tax, depending on the property value, might have gone from $1,200 to $1,800 a year.
Mm.
With the growth we've seen in rents, that got well and truly covered. There was no sort of necessarily net sort of cash flow impact. But that was one of the things that people saw. Now, the thing that really triggered property values to stagnate was not the land tax, but it was the response from some property owners, particularly property owners that had second, third, fourth investment properties in Melbourne or Victoria, or people that held holiday homes, where all of a
Yeah.
sudden, they had a portfolio of property, including holiday homes, that were, okay, they might have been asset rich, but they weren't. They were in some cases cash poor. So all of a sudden, they're having to fund these additional land tax, and they didn't want to do that. They put a lot of property onto the market. So a lot of
There's
property.
also off the back of 131 different legislative changes in rentals over the couple of years as well. So and a lot of the time those those changes were introduced very quickly, very rapidly, with not much consultation. And yeah, I think owners owner said, I'm not dealing with this any longer and sold up and moved elsewhere.
Yes, yeah. So we had a huge. I think a lot of the markets saw similar trends, but a lot of the most common trend we saw were our clients with holding Victorian properties that were selling up and buying into Queensland and WA. It was probably the most
Yeah,
significant
that's right.
most significant trend we've been supporting. The second thing was this interstate migration, outbound migration. So through that lockdown period, and I'll just bring up the data on that in a minute, but you saw outbound migration spike big time. So
Mm.
through 2020, 2021, all the lockdowns took place. Anyone that was thinking about moving brought forward that decision. So a lot of people were thinking about moving. One of the very common trends has been over a period of 10, 20 years or more, has been Melburnians moving to Queensland, not exclusively, but quite often moving to Queensland. If they were thinking about doing that on a 5 or 10 year time horizon, a lot of them, due to the lockdowns, had enough and just brought that decision forward. And you see that in the data, it very much spiked.
Mm.
So if someone's deciding to move interstate, what do? They put their house on the market. So not only were investors and other property owners putting their house on the market because of the increased land tax, with all this outbound interstate exodus essentially that was going on, you had a lot of homes also coming onto the market through 22, 23, and even into parts of 24. So all that supply coming into the market really held price growth back. Despite Melbourne having good population growth after that dip, price growth really stagnated. So
Mm.
they're the two big reasons. The third part is just this negative sentiment. The negative sentiment was, we all felt that. I mean, Tim and I, for those that are not aware, both of us live in Melbourne.
Mm.
Um,
I'm
and
starting to get the shakes as we start to talk about this again.
not a great topic to go
Not a
back
great
to,
topic.
but I think, it did create a lot of negative sentiment.
Mm.
And alongside that, people forget now, but we had a rapid rise in interest rates from 22. For May 22, we had 14 consecutive rate rises. Lending rates go from 2% to 6% alongside all of this.
Mm.
And that creates all this negative sentiment, particularly around the Victorian market. Now, and also just before we move on, this is the data. This is the ABS data that shows that spike that I just referenced, Tim, that outbound exodus that took place through particularly 21, 22, 23. It spiked big time. And we're not talking small numbers here. That's quarterly numbers. It got as high as 32,000 a
Yeah.
quarter leaving Victoria. So it's a lot of homes. The majority of people were selling up as they exited. So
Mm.
it's a lot of
Well,
homes.
the other thing is, Dan, is what people realised was selling up their Melbourne dwelling, what they could buy up north. That's changed a lot now, but
Yeah,
obviously it was showing real affordability in Queensland at that time.
yeah, and it's completely flipped. So that exodus is now completely stopped. Um, so in terms of what's driving the turnaround that we've seen, I think we're very much at the front end of what's going to be very, very strong capital growth rates for the next 2, 3, 4 years in Melbourne. But there is again, it's not one thing. Firstly, that interstate exodus has come to a complete halt, and you saw that in the numbers before. It's actually dropped. Those numbers before, if I go back to that, they are quarterly numbers, and there's a lag of about 4 to 5 months in this data as well. We think when we see that last, the far right there of the chart, it's below the long-term average, well and truly. It's been in decline now for about 7 or 8 quarters in a row.
Mhm.
That when the June quarter gets published, the September quarter gets published, we think that'll sit way below the average based on the current trend. But that's the first thing. The second thing is that the fundamentals are still incredibly strong, and I'll bring up some data to support that in a minute. Melbourne's become unbelievably undervalued and very affordable, as you just say, Tim. Brisbane looked affordable relative to Melbourne 4 years
Yeah.
ago. It's the complete opposite now, as we showed before in some of those median prices and the discount of between 20 and 30% that Melbourne's now trading at. There's then the yield. So people that are looking at Melbourne, investing in Melbourne, and they actually understand the numbers and they look at the yield
Mm.
relative to Brisbane and Perth. So Brisbane and Perth, the yields have actually dropped. There's been such significant price growth, capital value growth, the rents haven't kept up with that. And so the yields actually come back to from sort of 4.5 to 4%. In
Mm.
Melbourne, it's gone the other way. Melbourne's gone from 4 to 5 and up to also sort of low fives.
Hmm.
So it's
It's
actually
funny you
still,
say that, Dan, 'cause I still look at Melbourne and still see very low. I still consider it a low yield. But the thing is, we've been very spoiled. In the last 5 years, you've been able to get into markets where it wasn't, it wasn't hard to find 5%, wasn't hard to find 6%. But in those markets, we've seen significant growth, and that is becoming a lot tougher. And that's why,
yeah,
you've got, a lot of investors piling into places like Darwin where you can spend 600,000, get a house that's giving you a 6% plus rental yield.
yeah, yeah,
They got used to that type of yield that WA and places in some of the regional areas were giving. They're giving such strong yields that they've sort of got used to that and having to find it in places like Darwin. But as you
yeah.
say, now you see this big price growth in a lot of those locations. The yield's not there. Melbourne does start to come back into play, and you say, well, actually, these yields in today are actually quite reasonable.
They are absolutely, and where lending rates are today and where they're headed,
Hmm.
as we sort of in this what we expect to be a fairly consistent downward cycle for the next couple of years, is genuine cash flow positive properties, even at 85% yield LVR. So
Mm.
yeah, and the last thing is just improving sentiment, which is a really important thing in terms of momentum in the sort of into the Melbourne market.
Mm.
So actually, I think Tim, maybe I'll just sort of skip over a little bit of this. We've probably, I think, sort of covered most of it. But
Hmm.
yeah, Melbourne, very much a growth city. There's a little bit like the Queensland market. It's got a massive infrastructure program. I'll come back to that. And certainly, we're seeing apartments starting to very much outperform in certain areas. Actually, Tim, do you want to just quickly reference this piece?
Yeah, look, essentially, in our latest analysis of the spring edition of the Price Predictor Index, it sort of confirmed what we'd been forecasting for about 7 or 8 months now, and that is that the Melbourne revival was well and truly underway. So we've seen quarterly sales activity now sitting at the highest level since the 2021 COVID peak. And the balance has really shifted. So we've got like 64% of Melbourne markets now rising. Ironically, just before we started this webinar, Terry just sent me the latest data, and it's improved again. But yeah, there's only 22% of suburbs that were in decline, and this is across Greater Melbourne. So 64% were rising. The mix in between is quite stagnant. But what's even more telling is the surge in unit sales. So that's now also at the strongest peak, strongest it's been since the COVID peak. Units are now actually making up 37% of total sales across Greater Melbourne, and not necessarily just in units, but the areas that are leading the charge on the sales activity growth, which of course is what we believe to be a precursor to growth. So sales activity happens first, and then we see price growth happen later. Areas like Frankston, the city of Melbourne itself, and then areas in the north like the Hume areas are really showing strong activity. So yeah, I suppose the summary of that is that after a couple of softer years, Melbourne's firmly back in growth mode. And yeah, I think it's going to be quite a compelling market in 2026. Um, yeah, you touched on this already, the affordability factor. Do you want to go on to population?
Oh, sorry, mate. Yeah.
Yeah. So just mindful of time. Yeah. So we've touched on population a little bit too. There, maybe we skip forward and maybe do you want to talk about the more granular level population data?
Yeah, well, I mean, this we're just throwing this up on the screen here now,
Yeah.
just to show the Charter Keck Kramer data, which is showing population growth of all the capital cities, all the states, should I say? But Victoria being that orange line, it's a little bit probably hard to see on that chart, but it's tracking right at the very top. We're going to see we've got 2% or 2.3% average growth rate through last financial year. For the next 3 years, the forecast is that Victoria will track at the highest rate at about 1.7,
Yeah.
and those numbers are probably conservative based off what we've seen in more recent times. The other thing which we talked about Brisbane having a really tight housing supply market and apartment market, and this very similar picture we see in Melbourne. So Melbourne really needs to be meeting demand, needs to be running at about 12,000 new units coming to market a year. It hasn't been at that since 2021. Since 2021, it's been in very rapid decline. There's been very few new developments coming to market, relatively small numbers. And when you have a look at the next 4 years, Tim, you've got out of the known projects that have been announced, have been launched, are going to be built through and delivered through the next 4 years, it's not going to get more than about 5,000 apartments coming to the market in a single year. And that 28 number, we know that quite a bit of that is actually really 2029. That there's 3 or 4 key projects that are quite large, between sort of 500 and 1,000 apartments. Of those 3 or 4, they're really getting delivered in late 28 and really into 2029. So that's going to spread itself out. You're going to see really unit delivery coming in at probably around 3,500 a year for the next 4 years. So the Melbourne market for apartments is already tight. It's going to stay incredibly tight for the foreseeable future. And then the infrastructure piece, we spoke about Brisbane and everything that's going on in Brisbane or southeast Queensland that's state government funded. Melbourne's got some similar projects. They happen to be some projects now that have been underway for 3 or 4 years. And some of them are called out here on the charts: the suburban rail loop, the Northeast Link Tunnel, the Metro Tunnel, the Westgate Tunnel. All of those projects are well underway now, and they're going to be, they're still got, in some cases, they've got 4 or 5 years to run. And there's other projects on top of this, but a lot of that, as it starts to come on stream, like I think one of the exciting things I think being a Melburnian is the new city loop and the new rail that's going to open up next month has been a project that the state government's been promising now for 5 or 6 years, and it's been underway. But that's really starting to change in some areas. It's starting to really improve the connectivity. For example, parts in the southeast, in that inner southeast, they're going to be now even better connected to the CBD than what they ever have been. So lots of infrastructure still to come in Victoria. And Tim, we might just, if it's all right, I think maybe we just sort of jump ahead a little bit because we're probably
we've got a lot of questions in the Q&A, so let's leave a bit of fuel in the tank.
Yeah. So I think I was just going to close. One of the topics we're going to just quickly talk about is, what should investors sort of focus on and what should they try and avoid? And the first thing from our perspective is you want to be prioritising areas where there's really strong infrastructure spending going on. You also want to focus on areas where there is supply constraints. And we know that some of the outer areas, there is, I wouldn't say unlimited supply, but there is an abundance of supply for new land that is going to be released, and you want to be wary of that. You also want to be focused on areas where there's really, really strong rental demand. As an investor, you don't want to be having a property that's vacant or having long periods of time to try and find tenants. Yep. You're going to lose income, and you're not going to see rental growth that you will otherwise see. You also want to be in close proximity to key employment hubs. So those are from a location perspective, they're all really key things to focus on. You want to avoid areas where there's going to be oversupply, particularly in some of those outer ring areas. Yep. You want to avoid, if you are thinking about an apartment, you want to find something it's got modest body corporate fees, but really good yield. The body corporate fees are not something to be concerned about. If you've got the right investment and it's delivering, and the amenity that really the body corporate fees are covering, provided that is on point and it's good quality, and it's what the market needs, you will get a premium on your rent. There is no problem with that. And so some people get a little bit confused by that. And the last thing we would say is older established properties, be wary, be incredibly wary of getting into that. If you're a true investor, you will understand some of the benefits, and the depreciation deductions you're going to get on an older established property could be as little as $0, or it might be $1,000 or $2,000. If you really have a tax problem, or you're trying to reduce your tax, if you get into something that's new and off the plan, that's going to give you maximum depreciation deductions, $30,000, $40,000 a year, depending on the property, it's going to save you an enormous amount of tax. So they're probably just a few things, Tim, to call out. And lastly, I was just going to sort of touch on, why do people actually fail when it comes to property investment? We deal with so many clients where they're coming to us and they're now priced out of the market. They actually can't get in, and they always say to us, we just wish we had moved on this 4 or 5 years earlier. We thought about it, we almost did it, but they didn't. And the reasons they often don't is some of the things we've sort of brought up on the screen here, that they either have insufficient deposit or funds, or they think they have. They get confused by snippets of media and they get very short-term orientated. We all know that the media will dramatise things, and they will, try and create clickbait. 9 times out of 10, it's a distraction for people. They sometimes just lack the knowledge. They don't know really where to start. Sometimes it's just the fear of starting. They just don't want to take that first step. Sometimes they lack the professional support around them. Other times they're being influenced by friends and family that are armchair experts, that have had, some cases have made poor decisions themselves, and they pass that on.
Yeah.
And so they're influenced by the wrong type of people. And some people are just not prioritizing it. They let everything else in their life get in front of it, and it never happens. So they're really just some of the key things. But I think, given where we're at on time, I won't go into too much about these differences between established and off the plan. I certainly touched on a few of them, and we'll just sort of bring them up. But I think maybe, Tim, if you want, we can take some questions from the audience if you like.
Yeah, sure. There's a lot in here. So what I might quickly do, there's a few that I can answer really quickly. So I might just reel off a couple of answers, and then we'll dig into some more meaty ones. So there's a couple that we've already sort of covered off. Why rental yields poorer in Melbourne? I think for Raj, who asked that question, one of the first things I'd say is I still have the opinion, as I mentioned before, that it seems like a lower yield, but that's because of what we're used to. My recommendation for people now is, if you're going into a market like Melbourne, like Geelong, like Ballarat and Bendigo, and areas that are actually showing this rising sales momentum, you can expect the 4% rental yield in a lot of those locations. And if you're going into unit markets, you're probably going to get a stronger yield in a lot of ways here in Melbourne. Would you agree, Dan?
Well, I think it depends what type of property. It's where and what type of
Yeah,
property
where and what?
is being referenced there. The yield that we're on, properties that we're recommending, they tend to have 5% yield, or between
Mm-hmm.
4.5 and 5.5. In fact, on a number of the recommendations we've got, there's guarantees for 2 or 3 years at a 5% yield,
Mm-hmm.
right? So that just locks it away,
There you go.
takes any risk off the table. But we do see quite a lot of clients where, when you have a look at their existing portfolio before they come to us, they've got some pretty aged assets in there, like properties that they've held for 20 years, might have been their first home. They've upgraded multiple times since, but they've always held that as investment property.
Yeah.
And it's in areas where there's been very modest population growth. It's been a house that's been run down, and as a result, they're getting pretty modest rent, and the yields to 2 to 3%, where it should be 4.5 to 5.5.
Yeah. Okay, Greg has asked a question. Is there a possibility of other states introducing taxes similar to rates in Victoria? So it's important to know, Greg, that there is land tax in most states. You just got that they all vary with their thresholds and how much they are. Obviously, Victoria gets a lot of media attention because of it's only at $50,000 threshold. So just be mindful that you do need to understand what the land tax is in each state, but also be wary of the fact that it changes based on whether you're buying it in your personal name, in a trust, or whatever it may be. Dan, one of the questions we have here from Nazar is any recommended suburbs in Vic for good investment? You probably got a slide that you could show them to find that out. QR code, I believe.
Yeah, we're certainly very happy to take people through some of the recommended areas that we have at the moment. I'm just trying to actually bring that up, Tim, but something seems to have just
That's
stalled on
okay.
me for a second there. But yeah, certainly, if anyone did want to learn more about certainly areas that we're recommending, feel free to book in with one of our investment strategists. If you go onto that QR code, you can make a direct booking, pick a time and a date, and get yourself booked in. I mean, at top level, the areas that we've probably got our strongest recommendations in at the moment are inner parts of Melbourne.
Mm-hmm.
We've certainly like South Bank, CBD. There's just enormous demand. There's very little supply coming through, and we think people will do incredibly well there. Some very good deals at the moment in some of those areas, but also in some of the southeast pockets. So I'm not talking about Greenfield here, and I'm talking about a couple of areas, particularly in that sort of Glen Ira LGA. We really like that. it's a very densely populated area. It's right in and around all the key universities, Monash Clayton, Monash Caulfield, and then obviously the universities that are in the city. But areas that are close to universities, close to key employment hubs like Chadstone Shopping Centre, which is not just the retail shopping centre, but it's now an enormous employment hub with all the commercial towers there.
Mm.
Areas like that we really like, and we think they will continue. They do well long term, but we think over the next 3 to 5 years they will outperform.
Yeah, I'd agree. Couple more. So, from Raj again, what is your view on townhouse market in terms of capital growth and rental incomes, and where is the demand coming from?
The townhomes, yeah,
Yeah.
townhomes tend to be more affordable than homes, and they sit a little bit in between, probably. Like an apartment versus a home, just from a price point perspective. But they are suitable for small families. Actually small and growing families.
Mm.
You see a lot of townhomes with 3 or even 4 bedrooms can cater, but they're on a much smaller parcel of land.
Yeah.
So the price point tends to sit more between anywhere from sort of 600 up to about 850, but you're generally in that range, and depends where and what in terms of the quality of it. But yeah, a lot of it's small families, small and growing families, mainly townhomes. We
Yeah.
also probably have seen, you talked about it a little bit earlier, Tim, but one of the other things we've seen is people that are downsizing, people that are in that older sort of demographic, that are making that
Yeah.
life-changing decision. We're selling out of our home, and we're either going to move into an apartment or a townhome. A lot of them will actually choose townhomes depending on the location they want to be. So if they want to be much more city fringe, they'll tend to go an apartment. If they want to be a little bit more outer suburb, because that's where their friendship network is, or their healthcare network is, or whatever it might be, their family, etc., they will tend to go for a townhome.
Yeah, I found when they do, they are looking for something sort of single story still, because obviously
Yeah.
retiring into something with the staircase isn't always ideal.
Yeah, but there's
Washington,
also some townhomes have got lifts as well.
yeah, lifts as well. Yeah.
Yeah,
So one from Washington. At present, we are seeing some high vacancy rates in Melbourne suburbs such as Wyndham Vale, close to 9%, Donnybrook 4%. Do you see these rates reducing anytime soon? Should investors steer away from entering such areas? Well, firstly, I'd say yes, they're significantly high in areas like Wyndham Vale is only rising in terms of vacancy rates, and obviously comes down to an influx of investors in those locations. And obviously, you're probably looking at new build locations that have seen a big influx of property settling at a similar time too. That tends to be what happens. So it wouldn't be my cup of tea to be going into something with a vacancy rate that high, but these things do change over time.
yeah,
Dan, for
yeah.
yourself.
Tim, I'll just add to that slightly. Just look, the one area that we're quite negative about in terms of Melbourne is the west. So Wyndham Vale, Tarneit, Truganina. Like I know that a lot of people, and there's potentially people on the call that hold investment properties in those areas. Like
Yeah.
we are concerned about just the level of supply in those areas
Mm.
and the supply coming.
Yeah.
Right, so there are still quite a lot of large parcels of land that will be released to market over the next 12 months and beyond, and it's going to create a lot of housing supply, more so than what you can get almost in any other part of Melbourne.
Yeah.
But
It's the
Donnybrook was
obvious
an
growth. Yeah.
yeah, Donnybrook's an interesting one because if you go just slightly north, Donnybrook's it's just sitting a little bit in between. So I think they've seen a vacancy rates pop, but if you think about Craigieburn, Melton, even further north into Wollert, you've got actually a bit more infrastructure and services, and the vacancy rates there are much stronger. They're much
Yeah.
lower. You're talking about 1.5–2% vacancy rate, so it's actually pretty good and less supply.
Mm. So here, this might be a good question to finish up on, a bit of a summary for day. I've got a question from Sandy. So, Dan, is it better to buy in Brisbane now or Melbourne, considering all of what we've said today?
Great question. My God, well, it must be the leading question we've probably found. Most clients asking us over the last few months, really.
Yeah.
And I probably don't want to. It's probably sound like I'm going to sit on the fence a little bit here, but it truly is horses for courses, right? So it just depends on the client.
Yeah, it
You know, I
depends
think
on your circumstances.
if someone's got the capacity to be at the sort of in the $1.5 million range,
Hmm.
or above, there are some incredibly good opportunities in Brisbane still.
Hmm.
If they're more in that sort of sub-million range, I would be steering them towards Melbourne.
Yeah.
I think Melbourne's got probably more upside. If you think about holding property on a 10-year time horizon, I would
Yeah.
say Melbourne's got more upside. But there is very much investor dependent on their circumstances and what the existing portfolio they've got. You know, we're a deep believer in creating a level of diversification in someone's portfolio.
Yeah.
So if they've got already 3 or 4 properties in southeast Queensland, we probably would suggest they actually think very, very hard about somewhere like Melbourne.
Yeah. I'd agree. All right, well, that's about all the time we've got time for today. There has been a lot of questions in here, people asking about the slides and the content that we've had. There will be a recording that gets sent out from the iBuyNew team either later today or tomorrow, Dan.
I
Yeah.
think that's right. Yep.
Yeah, so you'll get all of that content in there. Thank you, everybody, for attending. Dan, thank you so much for presentation today. I think everybody would have got a lot out of that content. Really, really interesting stuff. So until next time, we'll see you all later. Thanks, Dan.
Yeah. Thanks, Tim.
Good
And
on you.
yeah, I hope everyone enjoyed that.
For anybody who has asked questions that's not that haven't been answered, and there are a lot of them, I should mention that Dan and his team will get those questions as well, so they'll reach out. Thank you all. Have a
Okay.
good day.
See
Bye.
you, Tim.